Imagine this, you're at the supermarket and your weekly shop seems to cost more and more each time. You check your bank account and it's looking a bit sparse. Later you open a letter and find out your monthly mortgage payment has gone up again. Sound familiar? This is the reality for many people as interest rates rise. Higher interest rates mean borrowing money gets more expensive. That means higher monthly payments on your mortgage, car loan, or credit card debt. It also means it's more expensive for businesses to borrow money, which can lead to higher prices for everyone. But it's not all doom and gloom. Higher interest rates can also be good news for savers, who will earn more interest on their deposits. However, for many, the negative impacts of rising rates are felt far more acutely than the positives. The reality is, understanding interest rates is crucial in today's economy. By understanding how they work and why they change, you can make more informed decisions about your finances. In the simplest terms, interest rates are like the price tag on borrowed money. When you borrow money from a bank, you don't just pay back what you borrowed, you pay back a little extra. That extra bit is the interest, and the interest rate is the percentage of the borrowed amount that you have to pay back on top. Think of it like renting a flat. You pay rent to the landlord for the right to live in their property. Similarly, you pay interest to the bank for the right to use their money. Just like rent prices can go up or down, so can interest rates. The level of interest rates is influenced by a complex interplay of factors, including inflation, government spending, and overall economic growth. Understanding these factors is key to understanding why interest rates are rising and what it means for your wallet. One of the main culprits behind rising interest rates is inflation. Inflation is the rate at which prices for goods and services increase over time. When inflation is high, the purchasing power of your money decreases. Essentially, your money buys less than it used to. To combat inflation, central banks often raise interest rates. This makes borrowing more expensive, which can slow down spending and help bring inflation back under control. Government spending can also play a role in rising interest rates. When governments spend a lot of money, it can increase the demand for loans, driving up interest rates. This is because governments often borrow money by issuing bonds, and higher demand for those bonds can lead to higher interest rates. Essentially, a variety of factors contribute to the upward trajectory of interest rates, and understanding these factors can help us navigate the current economic landscape. Thanks for watching Money Mavericks. If you found this video helpful, please subscribe, share, like, and comment. Your support helps us bring you more insightful content. The ups and downs of higher interest rates. As we've seen, rising interest rates can have both positive and negative consequences. On the plus side, higher interest rates can be good news for savers. If you have money in a savings account, you'll earn more interest on your deposits. However, for those with loans, higher interest rates mean higher monthly payments. This can put a strain on household budgets, particularly for those with mortgages or other large loans. Businesses are also affected by rising interest rates. It becomes more expensive for them to borrow money, which can lead to decreased investment and slower economic growth. This can ultimately result in job losses and further economic hardship. Overall, while rising interest rates can have some positive effects, it's important to be aware of the potential downsides and take steps to protect your finances. Take control of your finances. Navigating the world of interest rates and their impact on your finances can seem daunting, but it's crucial to be informed and proactive. Start by reviewing your budget and identifying areas where you can cut back on spending. Consider paying down high-interest debt, such as credit card balances, to minimize the impact of rising rates. If you're considering a major purchase that requires financing, like a house or a car, explore your options carefully and factor in the potential for further interest rate hikes. Remember, knowledge is power. By understanding how interest rates work and staying informed about economic trends, you can make savvy financial decisions and weather the storms of an ever-changing economy. Don't be afraid to seek advice from financial professionals if needed. Taking control of your finances starts with understanding the basics and making informed choices. Thank you for watching Money Mavericks. If you found this video helpful, please subscribe, share, like, and comment. Your support helps us create more content to guide you on your financial journey.